Welcome to Financial Intelligence. Now today we're looking at your business financial statements. And this is presented by Minton Financial Solutions, Financial Intelligence Academy. So, a little bit about me. You probably have already noticed my voice, right? Sounds like permanent laryngitis. No, I'm not sick. I get that quite a bit. It's actually due to a motorcycle accident when I was 14. Sideswiped a wood rail fence, landed in my throat and jaw area, and ever since, this is the way I've talked. So at least I don't have a trach or anything like that. So that's the short version of the story. There's a lot longer, but I won't bore you with it for this talk. Now, I also founded my own accounting firm, Minden Financial Solutions, and also a coaching course, which is Financial Intelligence Academy. So I'm also a CPA with a master's from Drake University with over 30 years of practical experience. Now, I'm passionate about making finances work for business owners, not just accountants. At the end of the day, your numbers should serve you, not the other way around. That's why I help small businesses and faith-based organizations gain financial clarity so they can grow and thrive. So today's goals. First, we want to demystify business financial statements. Make them simple. Kind of give an introduction to what they mean. Show how to use statements as decision tools. Provide a clear, practical framework. And share how to get ongoing support. So that's kind of the goals for today. Looking at financial statements. This is the GPS for your business journey. Ayn Rand said, money is only a tool. It will take you wherever you wish, but it will not replace you as the driver. And that is true, especially when we're looking at, our finances. So, why do financial statements matter? So basically, they're not just reports to your accountant. They show if your business is financially healthy or in trouble. They help identify problems early and let you know where to focus your efforts. It provides a clear, concise picture for you and others, like banks, investors, the IRS. And when you use them correctly, they turn numbers into insights and not just reports. Otherwise, without them, you're driving blind. Like I said, if you live in Iowa like me, you think you're headed to New York and you end up in California. That's not a good thing, right? So financial statements, again, your GPS. Now there's 4 main business financial statements, and they're the balance sheet, which looks at your assets, liabilities, and equity. An income statement, which is revenue, expenses, net profit. Cash flow statement, which is looking at cash in versus cash out. And that's all I learned when I was in school way back when. But there's also another one, which is equity statement, which is also the changes in owner's equity. So what's the balance sheet? Well, the balance sheet is basically looking at what you own and owe and what's left over. So the balance sheet provides an overview of assets, liabilities, stockholders' equity as of a certain date. And this kind of makes sense, right? Because you want to know as of a certain date, certain time, how much money is in your bank account. This changes. So the balance sheet shows how much cash, for example, is in your checking account as of a certain date. The balance sheet also showcases the liquidity and capitalization of an organization. In other words, it displays how the assets are funded, whether it be through company profits, debt, or investor financing, like equity. getting ahead of myself here. So let's take a look at the balance sheet. The equation is assets equals liabilities plus equity. So the assets is what you own. This makes sense. So this is what you have. Liabilities, what you owe. Credit card debt is right here. A mortgage, that's where the liabilities are. The assets could be bank accounts, checking, savings, investing accounts, if you have an investment. It also could mean buildings, your house, for example, whereas the liability would be your mortgage. And then the equity is what's left over for you as an owner. So what do we watch for in a balance sheet? Is equity positive or negative? If it's positive, that's good. If it's negative, well, you put more money into the business than it's worth. So you kind of need to be paying attention to that. And are debts manageable? Or is the asset mix healthy? So these are things to watch out for. Review weekly. Okay, this is just like checking your personal bank balance. Definitely monthly at the very least. Now we move on to your income statement. This is your business's report card over time. The income statement provides an overview of the revenue, expenses, and net income or profit of the business over a certain period of time. Unlike the balance sheet, which displays the company's position as of a certain date, the income statement displays the company's activity over a period of time. This kind of makes sense. So if you're looking at how much money did you make, it'll be over like a day, a month, a year, or a quarter. So it's over time. So how much is coming in or out. Here's the equation. We like math here, right? As an accountant, a little bit. Okay, maybe not. But the equation is revenue minus expenses is net income. And this shows performance over a period. It tells you, are you making or losing money? So let's take a closer look at this. So when you're looking at the key components, you have revenue, which is your sales or services. You have cost of goods sold. This is direct cost to deliver the product or service. And the difference of that, so you have revenue minus cost of goods sold. The direct cost to deliver the product is your gross income. And this is the profit after the cost of purchasing or producing what you sell. And then you have the operating expenses. That's the overhead, rent, administration, payroll, etc. Your net income, what's left after expenses. Now I just want to take a moment here. What's the difference between cost of goods sold and operating expenses? Many owners confuse these, so what's the difference? It does matter for pricing and tax. See, we separate the two because it shows us where the money is going. Cost of goods sold affects how profitable your product or service really is. The operating expenses shows how efficiently you run your business. As for tax purposes, the IRS only lets certain things go into cost of goods sold, so you want to get that right. Service firms only have operating expenses, so that makes it easy, right? But again, sometimes we consider things of cost of goods sold, but unless you sell a product then and have inventory, the IRS is saying, well, it's all operating expenses. So that when you do your taxes, even though you put money into cost of goods sold, it'll get reclassified for operating expenses for IRS purposes. So it's kind of something to keep in mind. An example. So we have revenue. So let's say we're selling cookies, and we sell cookies for $740. Now our cost of goods sold is our flour, sugar, labor, and let's say that's $340. So we made gross profit of $400. So we're making money off the sales of the cookies. but we had insurance, we had phone costs, we had rent. Now that's $250. That's your operating expenses. And your net profit is $150. So at the end of the day, we take home $150. So what would you do if the profit is low or negative, like gross profit? So if gross profit is negative, or not very much, then maybe we need to raise the cost of the cookies, especially if it's negative. What else? Maybe we should go and get cheaper flour, cheaper sugar. But if we want the premium stuff, maybe we need to raise revenue and have premium pricing. So that's kind of where the gross cost, some of the decision making goes into. Gross profit shows us selling cookies is profitable. Net profit if the business overall is profitable. So you have low gross profit, then you're either going to have to sell a lot of cookies so that you can make some profit, especially if net profit is negative, or you need to lower some of your expenses. Maybe you need to get less rent so that you can make a net profit. So this assumes you sell products. Again, a service-based firm does not have cost of goods sold, so that kind of makes it a little bit simple. Less common statements. This is the cash flows and the equity. Let's take a look at it in context here, and I also want to take a look at how the reports connect to each other, because that's kind of fun to watch, and it makes more sense as we go. I will say that cash flows is a little bit harder for most people to understand. A lot of times they don't get it. And the equity, again, it's another one. The statement of cash flows provides an overview of the cash coming in and going out of the business over a specific period of time, while the income statement focuses on profitability and the balance sheet shows the financial position at a point of time. The statement of cash flows tracks the actual movement of cash. It also focuses on what type of cash. It has 3 different types, whether it's operating, investing, or owner. So it shows a couple things. What the cash flows is basically trying to show you is, do you have cash coming in? You see the income statement. If you're operating on an accrual basis especially, you can have positive income, but you don't know it, but a negative cash flow. So the statement of cash flow is trying to focus on cash to give you a heads up on whether or not you have cash coming in or cash going out. And it kind of gives you a heads up again on, is the business going to last over time? Gives early warning signals that you're in trouble before it gets the income statement. So that's the cash flow and why it's important. Statement of equity, also called statement of owner's equity or statement of changes in equity. This shows how the owner's equity in the business has changed over a specific period of time. So this is kind of showing you how much money we're actually have as a part of the business. And it's over a period of time and not just quite like the balance sheet. So let's take a look at how they relate. Well, back up a second here. Statement of equity explains the changes that happened during the period, such as investments made by the owners, net income, withdrawals or dividends, and other adjustments. All right, here's how the 4 statements relate. Notice the income statement, revenue minus expenses, net income. That's great. So that kind of flows into the statement of equity and the balance sheet, because the statement of equity is your beginning equity plus net income minus your draws equals your ending equity. That matches the equity in your balance sheet. So this kind of, like I said, ties it together. shows why it's important. The balance sheet is your assets minus your liabilities. That equals your equity. Now the statement of cash flows. Beginning cash, plus or minus operating cash activities, investing activities, financing activities. The operating cash activities comes from operating your business. Investing comes from investments. Financing comes from what are you putting into the business as an owner, or public companies, what's coming in for selling stock, for example. And that equals the ending cash, which is an asset which flows into your balance sheet. So this kind of makes sense. It's a big statement, or it's a big picture, and it kind of shows why, if one part of it is incorrect, then everything else is incorrect. Your balance sheet, those balances tie or reconcile into outside items. It reconciles the statements, statements of loans, statements of your bank. If it doesn't match, for example, checking, it needs to reconcile to it, because there's always transactions that are outstanding that are not in the bank yet. Whereas savings accounts, it's pretty usually, those match up pretty easy. And so it's either going to match the balance of your bank statement, or it's going to reconcile to the bank statement. If it doesn't, then that's going to affect your income statement, which affects the statement of equity, affects the statement of cash flows. So everything starts getting crazy if they aren't accurate. So these statements drive better results. They're your early warning systems, and not, like I said, not just history for the IRS, because it allows you to make better decisions, to spot trends and problems early, plan for taxes, growth, tough times. It allows you to speak the language of bankers and investors. And it also helps with budgeting, which builds plans based on real data. So mentioning budgeting, here's some basics and basic overview for budgeting. So basically, we're looking at planning for cash, setting targets, and then adjusting. Why budget? Most of the time we look at budgets and we think, oh, restrictions, I can't spend like I want. Well, the purpose of doing a business budget is to track cash on hand, business expenses, and how much revenue you need in order to grow your business. It's not so much as restricting your spending as it is in planning how you're going to make money. It's planning your business. It's planning your personal expenses. That's what this whole thing is all about and why it's important. So why budget? It helps you anticipate cash needs, avoid surprises. It's not about restriction. It's about direction and confidence. Some tips. Never plan to lose money. Review weekly and monthly. Share with your team and your spouse. Helps you be accountable. And then be flexible. That way, if you're flexible, you can adjust as you go. You can make changes. So again, a budget is not just about restrictions. It's about planning and helping make better decisions. Some common pitfalls. 4 mistakes that derail your finances. So I just kind of want to hit on this a little bit real quick. Some common pitfalls to avoid is ignoring your financials. It's easy just to go on, check what's balanced in the bank, I've got money, spend it. But if you ignore your financials, you ignore the GPS. So you're just going on direct navigation. What happens if you're going the wrong direction? Another pitfall is confusing cash flow with profit. That's another one. I think I touched on that. Got cash coming in, but we're not making money. Or making money, but no cash coming in. It's also another pitfall is mixing personal and business accounts. This is easy to do, especially when you're a business. Business needs cash. I need to get some cash in there. And so we mix the two accounts. Ideally, keep the things separate. If you need to do a cash withdrawal, if you need to put money in, that's fine. But keep everything separate. It just makes better tracking, better management, better decisions for both personal and business. Don't mix. It's easy to do. I get it. I've seen it. It's not a good thing in the long run for your business. Fourth pitfall is not reconciling regularly. You need to do this on at least a monthly basis whenever you get your bank statement. That allows you to check in, see how it's going, making sure that you get rid of transactions that just show up like entered twice, transactions that are not entered at all, and it just helps you see what's going on in the future. Avoiding these mistakes prevents disaster. Most problems start small and then get bigger and bigger and bigger. The statements are for you, not just your accountant. Okay? Use them as a GPS for your journey. It's an early warning system, and it's a planning tool for stewardship. So that's what this whole thing is. I've seen problems start small, and we don't want that to happen for you. So look at these tips and catch the problems before they get big. A quick recap. Let's look at the essentials of your financial statements in one simple summary. Okay. The balance sheet is your business net worth. It's what you own versus what you owe. That's the balance sheet. The income statement is your report card. Do you have a profit or loss over time? Cost of goods sold versus operating expenses matters. It matters because of pricing, taxes, and profitability. This section wasn't just about definitions. You now have a framework. So going back to it, your balance sheet shows your financial health at a point in time. Your income statement shows whether you're making or losing money. And then understanding cost of goods sold versus operating expense helps you price correctly and control profit. So, review regularly, weekly or monthly, build some good habits. So regular reviews and budgeting help keep you ahead of the problems instead of just reacting late. Budget for your growth. Anticipate. Don't just react to what's going on. Use your numbers. Spot trends. Guide decisions. Talk with lenders or investors about it. See, most importantly, these are not just compliance documents. They're your decision-making tools. So some next steps, some resources, some tools and support to help you. So let's take a look at some things. I developed the Financial Intelligence Academy to help you build confidence with money and decision making. Learn practical tools, budgeting, cash flow, pricing, etc. I also wanted it to have a supportive community, live Q&A. Right now we got founders pricing available. It's some of the material that we went over in this is just a high-level view. The Financial Intelligence Academy, it actually delves into it. It has worksheets. It's got assignments that you can go through. It's right now at the basic course. It's developed over 6 weeks so that you can go through it in 6 weeks to learn how all these in more detail. The material for the business financial statements we actually get to in week 3, and it goes into much more depth. So we have modules for each section, basically. The Financial Intelligence Academy isn't about learning to read financial statements. It's a comprehensive program designed by CPAs to give you clarity and confidence in both your personal and business financial statements. We start with goal setting and mindset, move into personal and business statements, budgeting, technology tools, and KPIs. We wrap it up with projections, how to structure your finances for growth, and also there's a week trial. So go in there, sign it up. It's not priced real super high, so you can get in there. And if you have questions, let us know, and we'll be able to get in there and help you. Now, if you're looking for more direct support, my firm, Minden Financial Solutions, provides full-service accounting and tax services to help small businesses, churches, nonprofits thrive. So, depending what your needs are, we're here to try to help you. Now, I do want to start our end here with some common questions, because there are some. How often should I review my financial statements? And I would say, ideally, you want to do it on a monthly basis. And if cash is tight and you're growing fast, weekly. It's about building good habits, not about perfection. The second question is, number one mistake business owners make with their financial numbers, and that's ignoring them until there's a crisis. Make it a habit to ask, what's changed since last month? A third question is, how do I know if my business is financially healthy? And right there we look for positive equity, consistent profit, and manageable debts compared to previous months to spot trends early. So what I tend to like is to see how are we going comparatively from one month to the other, 1 year to the other. Look at it over time to see how are we doing. It's not just numbers for one time or one particular instance. It's also taking a look, seeing trends, seeing how things are going. That's how you know if you're financially healthy. Now, I'd love to hear your specific questions. Feel free to email us and we could help. In the academy, you can post a question. I will get right on there and answer your question so that you can get it and get the answers that you're looking at. So again, if something comes up, feel free to reach out directly. My email and the sites, again, are listed here. Let us know. I'm open to communicate, see how things are going. All right. Thanks for attending the session today.